Hi, and welcome to Future Focus, a financial strategies podcast where we make the complex simple. My name is Troy Branch with Ameritas Advanced Planning. I'm joined here today by my colleagues, Keali Joe French. You gotta say hi.
Hi.
Okay, and then Jacob Messick, who many of you have seen before.
Hey, Troy.
All right.
You want to know why I'm happy today?
I don't necessarily know if I want to know, but go ahead and tell me why you're happy today.
To give our listeners, before we get started with the episode, give our listeners a little bit of some background of the Advanced Planning Team. Advanced Planning Team, we crushed it at Trivia Night last night.
That is true.
So
actually, this is good. Tell them about it.
Yeah, so, as a team, we went out and competed in a local Trivia Night event, and we finished at the end of regulation tied for first. Now, we lost a heartbreaking tiebreaker to be the overall winner, but I still view finishing.
He counts it as a win. I do not.
I count it as a win.
I do not either.
I do
I'm
not
happy.
count it as a win.
I feel like we have quite a bit of knowledge outside of advanced planning topics, so
I will agree with that, but that was a loss last night.
I'll chalk it up as a win.
We did not walk away as we were not the last team standing. So
We were not the champions.
no more victories here. So we will see you again, Trivia. We will see you again. Okay, so let's talk about why we're here today. Today we're going to talk about OB3, and many people have heard about the big beautiful bill. We like to call it OB3. That's the nickname that our team has given the big beautiful bill. Now, why OB3? That may sound like that sounds like a Star Wars character. Well, you would be exactly right. We are unapologetically Star Wars nerds here, so we decided to have fun with the name and call it OB3 because, well, we like Star Wars. Now, we won't be talking lightsabers and Jedis unless we have another diversion.
I will say, if we have any Star Trek, any Trekkies on listening, please don't turn us off and shy away. If you are a Trekkie, you can come listen to us as well too. We like Star Trek as well. So.
Well, live long and prosper. But right now, OB3 is a Star Wars reference. Okay, so what we're going to do. And if our viewers haven't, if you've been frankly under a rock, back in July, sort of landmark legislation, the largest tax legislation actually since the Tax Cuts and Jobs Act in 2017. I will just go ahead and be the first contributor to the jargon jar. So the Tax Cuts and Jobs Act of 2017 was the previous large landmark tax legislation. And OB3 sort of dwarfs that in sort of the things that it touches and sort of the things that it's going to have effect on. So what we decided today is to go back to our old friend Myth or Reality, right?
Okay.
And so we're going to play Myth or Reality, where we're going to ask Keali, Joe, and Jacob questions. Myth or Reality. They're going to tell us myth or reality, what they think, and we're going to talk about it a little bit. We'll see how far we get. Sound good?
Good.
I like it.
All right. Okay. So let's go ahead and dive in. And again, we're just going to tell us myth or reality first, and then we can sort of dive in and talk about it. Okay. So the first myth or reality question is: OB3 only helps the wealthy.
I would say that is both a myth and a reality.
Well, we'll have to come back to that. That's that law degree, shining through.
It depends.
It depends.
No, I hear you kind of your question. I hear listening through it. I hear the word only, and we know with everything we talk about, always, only, never. Those definite terms are always a red flag. So I'm going to say it's a myth.
You're going to say myth, and you're going to say so. Let's start with it depends first.
Well, it can be argued both ways, in my opinion. There is a lot of stuff in here. If you're saying it benefits the middle class and the lower class, you could be correct, and you can point to tax on tips, tax on overtime, auto loan interest, etc. But I would come back and argue, okay, yeah, that benefits us today. However, it is set to expire in the next 3 years at the end of the presidency. Everything else, however, for example, we'll get to it, and I'll put one in here in advanced, Section 1202. Qualified small business stock. It gives really rich investors.
That sounds really.
I know. It gives really rich investors the ability to exclude up to $15 million from taxes, which is insane.
But I would argue. Okay, we're not going to divert on 1202 just yet.
Not yet.
I would argue it doesn't necessarily have to be rich investors. It could be. It
could be anyone.
It could be anyone.
Anyone up to that.
But it's people who are investing in companies who generally
That
have a
is-
lot more money.
Well, generally, but you
Okay.
could have someone.
Okay,
Anyway,
let's switch to a
forget
different one
1202.
then. The
Forget
estate
1202.
tax exemption was increased to $15 million. Unless you have a $15 million estate, that doesn't benefit you. There's a bunch of other things in here that are just permanent changes that tend to benefit the more wealthy individuals.
Okay. can
I
agree with that.
I guess I would say, from why it's a more of a myth is because while yes, there are things that may impact more wealthier individuals, a lot of those provisions have phase outs, which means you hit a certain income amount, you're just going to start reducing the amount of the benefit. Man, didn't know if you want us to spend a little bit of time. Hey, what some of those key provisions that
Sure,
might have
absolutely.
stayed the same or might have changed.
Because the whole purpose of this is we know when OB3, and of course we were just like everyone else doing all the stuff and getting prepared and trying to get as much information out to people as possible. There's a lot of stuff floating around that you're like, that's not exactly the way it's supposed to work, right? So we've passed that wave of information regarding OB3. So let's talk to people about why it depends, why it's a myth for you.
Yeah, I think there's a lot of things that are out that probably still need some additional clarification, but at least a good starting point of some of the, like, for example, a couple of the ones you mentioned. You mentioned overtime pay and tips.
Yeah, so let's talk about that.
You want to talk about it first?
Yes, overtime and tips. So a lot of people are really interested in the tax exemption on overtime and tips. Specifically, one thing I just want to make it known, this is a deduction, and I'll put another one. Let me explain deduction.
Thank you.
Deduction means, there are two different things, deductions and credits. Deductions mean that we're reducing your taxable income, and this all counts for my one pebble, dollar for dollar, okay?
Deductions, credits, those are two different words.
Hold on. Credits, on the other hand, means you're reducing your taxes dollar for dollar. So if I'm in the 10% tax bracket and it's a deduction, every dollar only saves me 10 cents, okay? These are deductions, not credits. Right. In addition to that, they're limited. For example, and I actually read the bill cover to cover, all 900 pages.
I can't deduct all my overtime
Not
pay
all of it.
or all my pay that gets paid in tips?
Correct. So with the overtime, there was a typo in the overtime one specifically, which it says that there is going to be a $12,500 limit whether you're single or married. So if you get married, you're pretty much halving what that deduction is because it's $12,500 period for either. The tips are different. The tips are $25,000, and that's if you're single, and then $25,000 each, married filing jointly. However, again, these are subject to phase outs, and they also expire in 3 years.
Right. I find it easier to describe credits and then people kind of get it. When you talk about a credit, it is a dollar for dollar offset against the tax that you owe. So if I owe $1,000 in taxes and I have a $500 credit, like I only owe $500 in taxes now.
Yep, $1 in a credit is equal to $1 saved, whereas a deduction is equal to a percentage saved.
Okay.
So,
all right, so keep going.
Yeah, so so there's those. I mean, if we look at just some general tax planning information that everyone has to be aware of when they file their tax returns, tax returns each year. And hey, this is a good time to say not providing any specific advice, just some general information like always. But, like we see things like the federal tax brackets, that were made from the tax cut in 2017. Hey, those were made permanent. A big part of it, why it's aimed more towards the middle class is, there was a standard deduction that got raised for those that were filed, single and joint. I guess the one note I had was more of the enhanced income tax deduction for seniors. So, those individuals 65 and older, I'm looking at you, Pop and Grandma, who I know you're watching this right now. I hope you click that subscribe and like as we're talking through this. But those individuals that are 65 and older, they have an additional bonus deduction up to $6,000 per individual, so $12,000 for a married couple. Now,
which expires.
Now, there are some phase outs for income. So, if you're making more than $75,000 single, $150,000 married, you start getting phased out. But really what that impacts is, let's say you're in that lowest tax bracket, the 10% tax bracket, for example, that extra $6,000 of a standard deduction for those seniors, 10% of that, $600. So it helps with some additional, relief on taxes just because of that enhanced deduction.
And I want to throw out there one more thing about deductions that people don't think about is that this is a deduction you take on your tax return. This doesn't mean you're not being taxed today. This doesn't mean you get your paycheck and you can take that exemption right away. You're actually paying those taxes and then filing for a refund. So this is a delayed benefit for you. A lot of people think it's, I'm not going to get taxed on it right this minute. That's not the case.
Those are all good things.
Let's say, and going down the list, I'm just
There's more?
There's
Good
more.
Lord.
Yeah, we're just
Lots of changes.
checking things off. I mean, there's a lot that kind of go into this one. I mean, we have some sections we're going to dive deeper into some specific things, but for a lot of just general planning conversations, like for example, families with kids, with young kids and kids, like I'll say, hey, like myself, a couple of things that come to mind. One is the child tax credit was increased to $2,200 per child, and I think they may have changed. I don't have on my sheet, but I know you have on yours the amount of it that's refundable.
Only
is
$1,700 is refundable, and that amount did not change though.
Okay.
That did not get increased.
but the total amount did. So
Yes, and that one's permanent.
but that went from 2,000 to 2,200.
Yes.
Yep. And then the other one that comes up that I know a lot of people have heard about are the Trump accounts. And, and what that does is, for those, those children that were born between 2025 and 2028. I'll pause. I know, like you said, you've read it a lot more than I have, so I'll let y'all kind of tee it up and let you talk about Trump accounts.
Yeah. So Trump accounts, I'll start this conversation off with the tax law is always subject to change. When we say permanent, we don't really mean permanent. Congress can come in and change. We have other things that are released like guidance and revenue rulings from the Treasury Department that actually will change that law.
Permanent to the next change.
Permanent till the next change.
There's either a built-in phase out or it's permanent till the next change.
So the Trump accounts in the actual tax law, we don't really know exactly how they're actually going to be administered. They do say it's going to be treated akin to an IRA account. However, this $1,000 contribution, I don't know if the government's just going to give you a refund on your taxes, if they're just going to directly deposit it into the account, etc. But you can essentially contribute, parents can contribute up to $5,000 per year to these accounts. It's not tax deductible, so you don't just get to deduct it from there. Employers can actually contribute to it as well. And the kids can actually take money out of it for qualified expenses being your college tuition or buying a house.
Educational expenses?
Nope, buying a house.
All right, go ahead.
So just qualified things like that. However, with these Trump accounts, while they may sound like, an interesting thing, there's a feasibility issue. And we're limited in how much that people can actually charge to run these accounts. So I don't know if people are actually going to be able to run these accounts profitably. People aren't going to offer them.
Or even how much you can, how much you can contribute. I'm sorry, I was still thinking about trivia night and Jumpman. For anyone that's listening, look up Jumpman and Donkey Kong, and
Mario,
AKA Mario before he was Mario. But one thing that comes to mind is the 5,000 limit that you can put in the Trump accounts. I can't remember if you said that or not already.
Yep, they did.
So
the bottom line though is with the Trump accounts is we just don't know enough. We the legislation named it, said do it, and then basically punt it to the IRS or punt it to Treasury and said, now go ahead and
figure
administer
it out. Yeah.
So I think that's going to be one of those ones where there's going to be more information coming out as it continues to roll with a lot of these things. It's, hey, here there's some general starting information. There'll just be more as things progress.
Mm-hmm.
All right. So
But we look at all those provisions. From tax brackets to standard deduction, enhanced deduction, overtime pay, tip pay, child tax credit,
Auto loan
Trump's,
interest.
a lot of things that impact a lot of the population. So
certainly not only the wealthy.
not only the wealthy,
Until it expires, and then it goes back to not so great.
That's still not only the wealthy.
but not only the wealthy.
That's, again, myth and reality. I
We could
think
have
it's
a
both.
We could do a vote. I think with 3
I'm
people.
going to be outvoted. I
three
already
people,
know
we
how
could
this
have a
is going to
majority
go.
rule.
Well, it's just the way it's written is only. So it's clearly not only.
Absolutely.
Only.
I just wanted to throw out there.
Okay.
The stuff that's good does expire.
Well, anyway.
Anyway.
Good as anyway. Okay, so number 2. Boy, if number 1 was like that, good Lord. Well, I don't know what number 2 is going to look like. Okay, the SALT cap is gone. And for those of you, I'm not putting in because that's
No,
actually how it's designed.
What's SALT?
SALT is state and local taxes. The SALT cap is gone. I can deduct all my state taxes again. For those like inside baseball, for those of you who don't remember, pre-Tax Cuts and Jobs Act, you used to be able to take all of your state and local taxes, and if you itemize, you were able to deduct all of your state and local taxes. So we can do that again now, right?
Do you want to answer first?
Well, once always, I feel like our listeners are going to start really listening the way you ask questions, because as if I'm sitting here taking that test, I hear the word all again. Or you said, I can deduct all my state taxes. All is so definite. I'm going to say myth.
We're not taking a logic exam. Just give us the answer. Okay.
This one's definitely a myth.
Myth. All right. So tell me why.
All right. That was a lot shorter answer than my drawn out answer.
Well, this is
I like the suspense, leave it on a cliffhanger.
Well, this is a myth because while there used to be a cap of $10,000 on it, they did temporarily increase the cap, but it's a cap nonetheless to $40,000. This is subject to phase out. For those of you who don't know what phase out means, it just means
You could probably take that out.
Can I?
No, because if you put it in for phase out, that means
No,
he's
'cause
got to
we-
put one
we-
in for
we
phase
kinda- we
out.
kinda-
Because he said phase out
We
earlier.
already talked about phase out a little bit. Because I explained it. You start getting to a certain income threshold, it's less of a benefit, and you can't utilize that full benefit. So,
okay.
I don't know.
Well,
if
it
that
sounds like you
explanation
need to
would-
put in
or
one,
you
and
could
I
al-
get to take
You could
mine
always
out.
have prepaid for the next one.
I'm going to prepay for the next one because I am going to use it. But yeah, state and local taxes, that one is capped. Now, keep in mind, after, I believe it's after 3 years, yes, it also reverts back. And it will phase out if you have a higher income, but you're guaranteed at least a $10,000 deduction regardless of what your income is.
So what does that income look like? It's $250,000 for single, $500,000 for married filing jointly. So, and like you said, you start hitting that. Hey, you have a minimum of the $10,000, which is what it was.
Mm-hmm.
I just had a realization that I'm old enough that I'm now can comment to the days, not just one tax legislation change, two tax legislation changes ago, that I remember the day when you could deduct all your state and local taxes.
So do I. That wasn't that long ago.
Well, it was almost 10 years.
It wasn't that long ago.
What, 2017? So that's
Yeah, so 2016
No,
is 2025. It's 9 years.
8 years. That's not 10 years yet.
Hold on. Like the Tax Cuts and Jobs Act,
It was in 2017.
2017. That's when it was signed.
It's-
It didn't start. It wasn't
it's 8
enacted
years.
until it didn't get enacted till 18 essentially. So that means in 16 we were still doing like the law was still I can deduct all my state and local taxes.
Yeah.
Where was this question at trivia night last night? If there would have been the Tax Cut and Job Act question, that would have been
Anyway, all right, let's keep it moving. Okay, so we answered the state and local taxes question. Okay, so let's talk about now question number 3. You can't deduct charitable contributions anymore.
Love this
Myth or
one.
reality?
I'll go first. I feel like it's been. I feel like I'm talking too much.
Go ahead.
Myth, myth, and only myth. No other commentary before answer.
What do you got?
Myth.
Myth. Okay. I'm sure you just threw the sound people off.
Good. That's what my intention was. I wanted it to be as loud as possible.
Yeah.
Myth.
So myth.
No, I
Okay.
didn't hear any laughing in the background,
Yeah,
so
that's
we're good.
All right. All right. So tell me why, or tell us why, I should say.
There's
Yeah.
3 reasons why.
Yeah, and I think we're really looking at 2 things. We're looking at people that. I was gonna say itemize and don't itemize.
go
I feel
ahead.
like
There we
I know I
go.
said a couple episodes.
So what is
that-
itemization? Itemize.
I
What
was
is
gonna
this
say
itemize you
there's
speak
words
of?
I use all the time. Like I use the phrase I use itemize before, but you'll catch me on that.
Yeah.
So really when you file your tax return, you can either do a standard deduction or you can itemize, which combines a lot of things to be able to not use the
Think of it this way. Your standard deduction is a freebie given to you where the government says you can deduct X dollars no matter what. Or you can take an itemized deduction where it's just actually based on your costs and it verifies or it varies from taxpayer to
costs.
taxpayer on certain costs. Charitable deductions is one of those costs.
That in order to get a charitable deduction, you would have previously had to itemize.
But let's think about what
I feel
that
like
means.
that's a good way without putting it. I was struggling because I knew whatever I was going to say. It's like, wait, I wasn't really prepared to go down this rabbit hole. And it's like everything I'm thinking of is putting pebbles in. So thank you for the save.
Yeah, but think of it this way. It's one or the other, standard or itemized. So you're going to pick the one that best suits you, that gives you the best tax benefit. So if your standard is at $15,750 next year, you need to have itemized totaling more than that. So if you're only given charitable contributions, you need them to exceed $15,750 before you'll even consider taking that deduction.
It's actually more than that because of the way
with everything.
It depends on what you give and all other good
Exactly.
stuff. But that's a handful of pebbles.
So
to go
because they made the standard deduction so high, they're trying to make it easier for you to contribute, and they changed some things in the charitable structure to do that.
Previously with standard deductions, there was no...
You had to itemize in order to get a charitable deduction.
And then,
outside of COVID, there was a COVID thing that
and
was
then
different.
now starting 2026, even if you don't itemize, you can deduct for single filers $1,000. For married filing jointly, you can do $2,000.
But there's strings attached.
Yep.
So that $1,000 or $2,000 can only be if you give it to a public charity, and it must be cash. Now, a public charity in the past has included what's called donor-advised funds, which is just a special way to give to charity. We don't have to go into that today. Just know that it does not include that for this $1,000. It has to be cash, and it has to be a public charity.
Okay, we're good.
So
that's number one. There's two more.
So that's for standard deduction.
Yep, you can standard or itemize and take that one. It doesn't matter.
Okay.
Now, itemized.
What else you guys got?
So for itemized individuals, they put in what we call a floor. And what is a floor? And actually, I prepaid. I just put an extra one there. This is my prepay.
Okay.
Okay, so a floor. A floor is essentially a hurdle that you have to clear before we allow you to deduct anything. In fact, I like to use this example of like buckets with water. You have a bucket of water. You have to fill up that bucket before anything runs out. All the excess water that runs outside the bucket, you get to deduct. But anything in the bucket, you don't get to deduct. So we need to fill the bucket first before we can deduct anything else. So what was that exempt or that floor now for individuals? It's 0.5% of your adjusted gross income. So if I make $100,000, I have to spend at least, what's that?
That'd be 2,500.
No, 0.05%. 50,000.
I'm tapping in the,
It's 5,000.
We're
Math is hard.
Here we are sitting with Jacob and the JDs. And we got the two JDs who can't do math.
Excuse, I have an accounting
we got
background.
the finance major. 0.5% of 100,000 is $500. $500.
500. Okay, yeah, my math is bad. 0.5%.
Yeah.
So if you make 100,000, you have to spend 500 before you can deduct a single dollar of that.
Yep.
Can I ask a question?
Yes.
In this bucket that's being filled up, and we're only carrying it away, whatever fills up the bucket, is that on our back walking up a mountain with, anyway, if you wonder where, just go ahead and tune into the other episodes and you can see where that, like where that thing goes.
Appreciate the effort on trying to land that joke.
Yeah, it was good.
You did your best.
It was a good effort.
It was a good effort. Anyway, all right,
So there's two floors. That one was the individual. Businesses have a floor as well, but theirs is higher. Theirs is 1%. There was one other change, though, to the charitable deductions as well that don't really apply to many people. But in case you're interested, if you want to give to a charity that provides scholarships that's approved by the state, specifically to K through 12 individuals, you can deduct $1,700 before itemizing. That's just a random freebie. That's an FYI. It doesn't really matter.
But you're not getting that in the social media video.
No, you are not.
That's some extra credit right there.
Exactly. So that's myth or reality, and we've primarily focused on the individual. Mm-hmm. When we come back for our episode 2, we will focus in on estate planning. We'll focus in a little bit on the business owner. We okay with that? Are you guys good to do another episode?
Good to go.
I like it. Yeah.
So we'll look forward to seeing people back for episode 2, and I'll say, as I always do, like Jacob has already said, make sure you like and subscribe. Make sure you like and subscribe.
Smash that like button.
Smash the like button.
Grandma
as
and
Pop,
Pop,
like to say.
like and subscribe.
Exactly. And we'll look forward to seeing you on part 2 of our examination of OB3, the big, beautiful bill. Thanks, and we'll see you soon.